Welcome to the Real Estate Investing Podcast, where we help you unlock your potential freedom through land investing, real estate investing, and entrepreneurship. Hey everyone, this is the Real Estate Investing Podcast with today's guest, Josh Cantwell. Josh is the host of the Accelerator Investing Podcast and CEO of Freeland Ventures. Freeland Ventures owns more than 3,000 units of apartments across the U.S. and has been involved in over 1,500 real estate transactions. Josh, welcome to the show.
Hey, Dan. Thanks for having me on, man. Looking forward to sharing with your group.
Amazing. Yeah. Is there anything I missed in that intro that you want to add to that?
I think long, short, my investing career has been kind of three parts. For the first 5 or 7 years, we did residential, primarily wholesaling and flipping. The next 5 years, we ran a private equity fund where we were not only investing, but also doing a ton of private lending and hard money lending out of a fund structure that we stood up. And then the last 5 or 7 years has been all about multifamily and apartments. And we've done 19 syndications. We've owned as many as 4,500 units of apartments. We sold off about 1,400 units last year. Wow. I'm also a pancreatic cancer survivor and a father of 3 amazing kids. And I love to coach volleyball. I grew up playing football, basketball, baseball. I played college football, but my favorite sport's girls volleyball. It's super fun to coach and be around. So that kind of rounds out the intro, I guess.
That's amazing. I'm sure it sounds like you have a ton of real estate and personal experience. Went through a lot, obviously, with your cancer and all the treatment and everything involved in that, I'm sure. And we'll get more into that side of things. But I'm curious, how did you get started in your real estate career? Obviously, going from 0 units to thousands of units doesn't happen overnight. What did that path look like for you?
Well, look, I think it starts with my first very mini career in financial planning. When I graduated from college, I was fortunate that my father was an entrepreneur. My dad owned an employee benefits company. He was focused on large companies and providing all their employee benefits. And I got to observe entrepreneurship in my own home. My dad built a business from nothing. He had 1 employee, all the way up to 45 employees. I saw my family go from filing bankruptcy when I was in 6th grade to my father owning a second home and a 3rd car, and dressing different and talking different and acting different and having a building that he owned and a business that he owned. So I got to observe entrepreneurship in my own house. And so when I graduated from college, my dad almost lost his marbles when I actually went into financial services myself, and I never got a job with a real salary. I actually got into financial planning. It was 100% commission. But I got my Series 666, 63. And I observed very early, Dan, that my wealthiest clients owned real estate. They had more money in real estate than they had in the financial markets. And so I started looking at, okay, they owned these apartment buildings. They owned strip centers. They leased them out to restaurants and retail stores. And they owned, single family portfolios. So I started going to boot camps when I was 24 years old. By the time I was 25, I decided to quit my job cold turkey, jump into real estate. And like most people, I didn't have a lot of money. Even though I was a financial planner, I had done well. I pretty much blew all the money I made, just like most 25-year-olds would do. And I had a good time with that. But I decided to get into real estate because it was the freedom of passive cash flow, the idea of wealth and equity, and versus, helping other people achieve financial independence. I wanted to do it for myself. And so like most people, I flipped houses for 5 or 7 years. I never really built a portfolio because I was really worried about the income that I needed to live on. And that income became like a drug. Like it was so much income and it was coming in. I didn't feel like I needed to build a portfolio until I got sick with cancer. When I got sick with cancer, I realized I had made a huge mistake in that I knew I wanted to get into real estate for passive income, to create a portfolio and ultimately financial independence, but I really had built myself a job flipping properties. And when I got sick with cancer, I was ripped away from work for about 9 months, and I realized I had made a huge mistake. And then I vowed in the second half of my life that I wouldn't make that mistake again. And so I've been fanatical now about private money. I've raised and deployed over $100 million of private money. I've owned as much as $350 million worth of apartments. And now I'm finally feel like I'm doing it the right way, the way that we learned from Rich Dad, Poor Dad. And what I ultimately set out to do back when I was 25 or 26 years old, I finally feel like I've accomplished that. And it definitely hasn't been overnight. It's been about a 20-year journey.
That's incredible. What would 9 months? So you said you took 9 months off, and that's when it kind of hit you that you're doing things too hands on, the flipping for income. What would 9 months off now look like? I mean, what's the main difference you're seeing there? Just more passive income?
Well, for sure. Also, the larger the deals that you do, the more you can build infrastructure of people and software and systems. The smaller deals you do, the smaller team you have, the more you have to do by yourself.
Right.
So what I found now is the larger buildings that we've bought, the bigger syndications we've done, the bigger portfolio we've built. Now, each of my team members, there's about 12 people on my team full time. They each have their own unique job within within our business. Like I have a VP of construction, that's all he does. I have a project manager for construction, that's all he does. I have a accounts payable, accounts receivable person, that's all she does. Versus when I was flipping houses, doing smaller deals, the deals weren't big enough, the profits weren't big enough, the cash flow wasn't big enough. So I had to do a lot of it myself because I didn't have enough deal flow or cash flow to support all those people. So today, like I don't think based on what's going on right now with interest rates, the Federal Reserve, the cost of debt going skyrocketing, Dan, I don't foresee my firm doing a lot of acquisitions for the next 6 to 12 months because the cost of debt is prohibitive.
Right.
So now if I end up taking the next 6 or 12 months off, not only is the team in place, but the cash flow is in place to support all of that. And the passive income is there that I could take the next 6 to 12 months off, the next 9 months off and not work at all. And we really wouldn't skip a beat, like me personally or the business wouldn't skip a beat. Versus, back then, if I took 9 months off when I was sick with cancer, which I did, we weren't doing any acquisitions. We weren't doing any deals. So I wasn't making any money at all.
Right.
That's the main difference.
So you have those systems and everything in place now to kind of run itself if you were to take that 9 months off. But you said, so for the next 6 to 12 months, I want to touch on this. You said your acquisitions are most likely paused, right? So
for the most part. So to give you an idea, Dan, like last week, we had 3 deals that we were working on for about 90 days. Large commercial deals, $10 million, $15 million, and $8 million. So about $30 million in deal flow. And we were awarded all 3 deals from the brokers that we were working with. We made offers, we were in competitive situations, other people were offering on those buildings. The brokers knew us and knew we were a very, very qualified buyer and that there was a very high certainty of closing if they gave us the deal. So even though we weren't the highest offer, that weren't the highest price, they awarded it to us and said, basically, if you want it, it's yours. Well, we then took about a day to reevaluate every deal, and we ultimately tapped out and decided not only to not like lower our price, but we decided to just opt out of the deal entirely and tell the broker we don't even want it at any price. We don't want it because the cost of the debt is so much more expensive than it was a year ago or even 3 or 4 months ago. So with that being said, I don't think that sellers are going to be realistic. Sellers right now would have to drop their prices by a couple $1 million so that the deal could cash flow for the buyer. And I don't think sellers will do that. So I think it's going to take 6 months to 12 months for sellers to get realistic. I think rates and inflation is going to stay high for the next 12 to 18 months. And I think rates are going to stay high, which just means that acquisitions are going to slow down a lot for everybody, not just for me, but for everyone.
Do you have that same trajectory for residential, smaller? Because a lot of people listening, $10 to $20 million deal sounds great, but they're just getting started. Maybe they want a duplex, multifamily, a few $100,000. Do you see that same interest rate being reflected from the sellers in that 6 to 12 months that you're saying they're going to drop their price enough to be able to cash flow? Do you kind of see that same trajectory?
Yep, I do, but it's different. With residential, I think there's always yield to be had. There's always a spread to be had when you're finding a seller who has various levels of motivation, like the traditional Ds, right? Death, divorce, disability, those types of things will still happen. And when that happens, you can create the spread or the gap, the yield between what a seller is willing to sell for, let's say $100,000, whether it's land or whether it's a house, and then what you can flip it for or rehab it for and sell it for more. I think that's always going to take place more in resi. In commercial deals, the sellers are so sophisticated They have lawyers, they have property managers, they have asset managers, they have investors. You're talking about tens of millions of dollars.
Right.
And those deals have cash flow. So the more cash flow they have, the less motivation they have to dump a property fast. So in multifamily, especially the bigger deals that we do, it's tougher to find that spread or that gap between what is today's market value and what's the seller willing to sell for. Versus in resi, you might find a property where market value is 250 and a person's willing to sell for $125
Right.
because of distress, delinquency, deferred maintenance and all those things. That's still going to happen. Matter of fact, if there is a recession, you'll probably see more of that. You'll see more divorce, people getting laid off. You'll see more distress. So you'll see more of that motivation from sellers. Whereas in commercial, guys sometimes are thinking 2 years, 5 years, 10 years, Dan, before they decide to sell.
Mm-hmm.
They own these properties for a long time, and they have this cash flow, this underlying cash flow where they don't have to sell. So the distress is not as real or as apparent. Now, what's going to happen, Dan, and I'm predicting this is going to happen now, so I'll tell your audience, this is what's going to happen in commercial real estate, especially multifamily. Over the last 1 to 4 years, a lot of buyers have bought commercial real estate with what's called a SOFR loan or a bridge loan that has a floating rate. It's almost like an ARM loan, like we learned about the ARM loans and the ARM adjustments back in 2008, 9, and 10. As these SOFR loans adjust, as interest rates adjust, and the cost of that debt goes up, some of those sellers are going to get into a bind because their cash flow is evaporating because their cost of debt is going up while they own the property. And while they own it, now they have to sell or refi to get out of it because they're going to start to bleed cash. But that's going to take some time for that to unfold. But I guarantee that there's so many billions of dollars of SOFR loans out there that are now readjusting and the rates are going up that those commercial owners are going to get in a pinch. That's where the motivation will come with commercial.
So they got in at a good deal, what appears to be a good deal. The rate's going up, they were cash flowing, and then they start bleeding, and then they're forced to sell eventually to liquidate.
Exactly.
Interesting. I've been pitched SOFR loans quite a few times. I've never bit on one, but I was curious to see how that's. Yeah.
Don't use them, Dan.
Okay,
one of the best decisions I've ever made is in the last 3 to 4 years. We bought everything with fixed rate financing that had long-term terms. So 5 years, 7 years, 9 years, 12-year terms on it. And the guys that had SOFR loans that were 2 years, 3 years, and then now the interest rates are skyrocketing. Those guys are going to have some serious motivation to get out of their deals. Luckily, we were smart enough to lock in those interest rates for the long haul.
Got it. Awesome. Well, I know you were in the educational space for quite a bit. What advice would you give someone who wants to get started in real estate investing or even just wants to pursue a passion of theirs? And what's the advice to be able to turn that into a career that you have for them? Because I know you have that educational background. You've probably seen so many people come and go, successful, not as successful. So what's your opinion on that?
Look, I think specifically for real estate, Dan, it's got to be funding first. When we were flipping homes and we were very transactional up until my surgery, it was primarily because we didn't have access to private money, like true private lenders and private investors. The mom and pops that have 100 grand, 400 grand, 600 grand, accredited, non-accredited. When my portfolio blew up and our cash flow blew up, it was because we decided to focus on creating those relationships with those private investors first. And then once we had those relationships, we knew that we could go close a $10 million deal or even a $500,000 deal or a $200,000 deal. So I tell a lot of audiences that funding equals freedom. And I'm not talking about bank funding. I'm not talking about institutional funding. I'm talking about true private money, private lenders, and private investors. That type of funding is the toughest funding to get. But when you get really good at raising it, now you have the freedom to go buy whatever you want. It could be mobile homes. It could be self-storage. It could be land. It could be multifamily, because you're liquid. And maybe you personally are not liquid, but you're liquid because you're using other people's money. You can now go buy and structure deals. It's not the opposite. The opposite, Dan, what a lot of people say is go find the deal and the money will follow. I think that's BS. And not only that, but the Securities and Exchange Commission rules dictate that you have to have a prior existing relationship with those investors before you offer them a deal. So funding equals freedom. That's number one. Number two, I would say, Dan, look, if you're not doing something from just a general entrepreneurial perspective, if you're not doing something that you could go work if you had to 20 hours a day, 7 days a week, if you're not doing something that you really enjoy and that you would almost like do it for free, then you're in the wrong swim lane. You're in the wrong niche. Entrepreneurship is very hard. When you decide to become an entrepreneur, you're basically saying, I'm going to give up my W-2 job. I'm going to give up what I feel like is the security of a regular income. I'm going to give up on a lot of these things just so I have the right to go work 100 hours a week for myself. Like, I'm going to give up my 40 hours a week and my guaranteed paycheck, my W-2, so I can actually go work harder and put in more time and more hours just for the personal freedom that entrepreneurship provides. When you sign up to be an entrepreneur, you're saying that that personal freedom to make those decisions is what you care about more than anything else. Okay? And so if that personal freedom now says, I'm going to go do something to make income, to make a living, it's got to be something that you really enjoy, because it can be hard, it can be long, it can be frustrating. People can let you down. There's deals that you might be able to, want to close, and the funding doesn't show up in time. You're going to get smashed in the face and your knees chopped out from underneath you. It's going to be hard. I've done this for 25 years. I've never had a boss, so I know what this is like. But I get up every day, and great entrepreneurs get up every day because they truly enjoy the journey, the grind, the time of meeting the next contact, creating the next joint venture, raising the next capital. So I would say, look, there's two things to summarize. One, funding equals freedom. And two, if you're not doing it and would have done it for free, then don't be an entrepreneur, right? Because you're going to have those bad days. You're going to want to quit if you're not doing something you truly love. I love real estate. I love the game, the chess match. That's why I get up and do it every day.
Awesome. I want to touch on number one, funding equals freedom, because for me, this has been probably the hardest thing to overcome in my entrepreneurship and real estate journey. I have different real estate rentals and multifamily in Cincinnati, and just being a young entrepreneur, sourcing debt, loans has been one of the biggest challenges in real estate. So touching on that funding equals freedom, what methods have you used or seen successful for younger entrepreneurs? For me, like, I could have got easy loans, conventional loans, when I was working my W-2 before I quit for full-time entrepreneurship. And then all of a sudden I quit and the banks look at me completely differently. So I've really struggled with that. And I know a ton of other people are as well.
Sure. I would say, look, I think the first thing is, again, going back to the do bigger deals. Banks, the toughest money to get, right, is the $500,000 to $1.9999 million. That's in that weird middle gray space where it's too big for one person to kind of sponsor the loan, but too small for most commercial banks. Most banks love to fund deals that are 2 million and over, even 1.5 million and over. 1.5 million, 2 million and up allows you to start to look at the deal, where the banks look at the deal and the cash flow more than they look at you personally. Okay. And so when you're looking at deals that are 1.5, 2, if you're looking at $1 million deal, you might as well go look at a $2.5 million deal, because the funding will be easier to get at 2.5 million. Just trust me. I've done this many times. The deals that I went and got, like an $800,000 loan, I had to go through more hoops. I had to personally guarantee it. They looked through all my income, all my assets, all my experience, and it was still hard to get. The last loan I got was $15 million. And they primarily, of course, they asked me for tax returns and my liquidity and some of those things. But they know that I can't personally pay a loan that's $150,000 a month. So they look at the deal more than they look at the operator. They look at the deal, and can the deal cover the debt versus can I personally cover the debt? So the first thing I would say, Dan, is do bigger deals. The easier the funding is to get. But number two, the funding with private investors, right? This just has to be something that every real estate entrepreneur, whether you're doing resi, commercial, land, flipping homes, multifamily, it doesn't matter. You have to go start to present to investors and talk to investors before you need the money. And so it becomes a situation where, Dan, when I started raising capital when I was 27 years old, I was young. I didn't have a ton of contacts. But what I did was I created a physical newsletter that I was 2 pages that was physically printed out at a printer. I created what I called my Project 100 of investors, clients, friends, family, colleagues. And I physically mailed it out to all of them once a quarter. And then people started to see in that marketing what I was doing. I would put case studies in there. I would put quotes. I would talk about the economy. I'd put some of my deals in there. And then eventually I would start following up behind that with some phone calls. And I would just ask people, hey, did you get my newsletter? What did you think about it? And they would say, yeah, I got it. I read it. What's going on? And then I would say, well, look, we've been friends, families, colleagues, whatever for a long time. I want to just get together with you sometime, whether it's over a Zoom or whether it's face-to-face or over a beer, bowl of soup, whatever, and just tell you a little bit more about what it is that I'm doing so that in case you ever run across anybody who's interested in investing in real estate, that I become your top-of-mind reference. So I would approach it like I didn't care if somebody had money, if they didn't have money, if they could refer me to people, if they could cheerlead for me. I didn't care. I would go meet with them. Then I would present with them what real estate investing, creative investing, and private lending or private investing, what kind of returns they could get. And then at the end, I wouldn't say, hey, would you invest with me? What I would say was, do you know anybody that you think would be interested in learning more about what it is that I'm doing? And then I started finding people that they would raise their hand and say, what about me? Like, I would love to get a 10% return, or I would love to get a
Absolutely.
12% return, or I would love to get an 8% preferred return plus equity in your deal, or I would love to partner with you on this land, or I would love to partner with you on this multifamily deal. What about me? So I went in assuming only that they would cheerlead for me. And then I found people raising their hands and saying, well, what about me? I've got 100 grand, or I've got 50 grand, or I've got 500 grand. What about me? Or, hey, my brother has a successful business, or my parents are retired. They need a better return on their capital. So I went into it just educating and then asking, who else do you know? This is a strategy I learned as a financial planner. When I was going as a financial planner, this is the same thing that the Keller Williams agents are taught when they become a new agent, is cast a wide net, farm an area, talk to everybody you know. You never know who's going to sell a house, but you're going to get a listing if you're a Keller Williams agent. It's in Gary Keller's book, the 1% or whatever his book is. It's all in there. So I took the same approach, Dan. And then I found people started referring me, and people started investing. And then they started saying, well, I've got this $100,000. I just lost money in the market. What can you do with it? And I started building these relationships. Then I started really getting professional about it. I built sales funnels and internet marketing funnels, digital funnels. I built online and offline marketing campaigns. And then I started to fill the funnel with leads. And then it mushroomed to $100 million. But it started friends, family, colleagues, and just educating them and not asking them if they had money, but asking them who they knew that would want to learn more. And then they would say, what about me? Right? And then they were hooked because they convinced themselves to invest with me. I didn't convince them. I just presented to them and they convinced themselves. So that's where I would start. I would just do exactly what I did 15 years ago.
Yeah, and then they naturally come back because you're presenting such a great thing. And then they see, with the referrals and everything, casting such a wide net. That's really cool. What, early on in your career when you're 27 and you're pitching these people, what were you pitching for exactly? Like, what were you taking their money? Were you doing syndications at that point, or just raising money for down payments and splitting equity? What were you doing then?
Yeah, back then it was primarily traditional rehabs. And I had a great offer that I thought converted really well with a lot of people, which is I would pay investors 12% interest, simple interest, or 15% of my profits, whichever was greater. So investors started to say, ooh, wait, like my floor, my minimum is 12%, which is better than the stock market. But I have the upside if you flip this house pretty quickly, or you flip this piece of land really fast, or you do whatever your money-making strategy is quickly, and you make money, then I can get 15% of the profit. If that's more than 12%, then my returns could be 15% annualized or 18% annualized. I flipped a house once so fast that a guy got a 39% annualized return. And he's been investing with me ever since. So 12% interest or 15% of my profits, whichever was greater. That's what I really started with. Another thing, I don't like if you're doing rental properties, you could say, okay, I'm going to pay you basically an 8% preferred return or a 10% preferred return plus 10% of my equity. You'll be a partner in the deal for 10%. So I'll pay you the first 8 or 10. Before I get paid, you get paid, Mr. Investor, and then an additional 10%. People love getting a kind of a fixed cash flow, Dan,
Right.
plus the cherry on top of the cake of the extra possible return from the equity. They love that. Today with my syndications, we always pay a 6, 8, or a 10 pref plus equity. And when you add the equity, these investors end up with a 20 to 25% annualized return, and they love it. And we've raised tons of money that way. But it started on simple rehab flips, 12% interest and 15% of the profit.
Yeah, and for anyone listening, if you are a land investor, this is what we try to pitch. Get creative because land investing is such a new market. There's not as many people doing it out there. So what we do now, we have a group of investors in our community and they raise money for other investors. And then you do like a 50-50 split and the returns are pretty nuts on both sides for them. But there's so many alternatives to get cheaper money for people who aren't in the land investing space. Like you're saying, go to friends and family, offer that kind of guaranteed principal fix or a profit split. There's so many ways to get creative with raising money. I feel like it's not really tapped into in this space as much. But going from there, for someone just getting started, what throughout your career, what are some of the biggest mistakes you have seen in early investors?
Look, I think the principle of real estate investment is long-term passive cash flow. That's why we do it, right? So I think one of the first mistakes that I made, that I think a lot of investors make, is thinking just far too short-term. I think if I could redo it, I would have kept every deal I've ever flipped. I also, one of the things I love is taking acquisition fees at the front end. Right? A lot of people think like I've got to flip this property because I need the money. Well, why not restructure it a little bit more creatively? Where if you let's say you get a private lender, let's say you're buying a piece of land for 100 grand, and you think you can turn and flip that piece of land for 150 grand. Why not borrow 105 grand or 110 grand, take an acquisition fee off the top up front so that you're not so dependent on the back end profit. Take a little bit of an acquisition fee up front and then try to hold the land for cash flow, hold it a little bit longer. Maybe not be so motivated or desperate to flip it fast because you need the money. Today with our apartment buildings, we take an acquisition fee every time. As a matter of fact, in commercial real estate, it's very normal for a 2 to 3% acquisition fee. So you buy a $10 million property, you could easily be making $200,000-$300,000 up front, which last year we did 8 syndications. So I got 8 acquisition fees. It was massive. So that's one of the mistakes I think. I never thought about that when I was younger. I was always like, I'm going to wholesale this. I'm going to flip it quick because I need the money. Versus let's restructure it. Let's try to find a way to get an acquisition fee and keep the real estate long term and turn it into a cash flow scenario. Okay. Whether you buy a piece of land, maybe you get a private lender on it, and then you turn around and sell it with owner financing, or you sell it with a wrap, and now you create cash flow between what your payment is to your private lender and what you're getting from the buyer. That creates a piece of spread there or yield in between. It creates some passive income. So I just think like I went way too long, up until my surgery, almost 5, 6, 7 years of just flip, transaction before I really got serious about building a portfolio. A lot of people don't like doing little, single family homes for a portfolio because it is a lot of work. Tenants, toilets. It's one of the reasons I haven't done land, but I own land. I'm actually developing land right now, but it's One of the reasons I think people like land is the ability to not have all the work that goes into rental real estate. But whatever it is, land, single family, multifamily, commercial, I would focus on creating regular recurring income. The only way you become a lifestyle investor where your lifestyle's first is to create cash flow first. That's all that matters.
Really cool advice. Yeah, I see people thinking way, way too short term in all forms of investing. I feel like just getting over leveraged in one area, thinking of the 1 to 2 year income potential rather than 20, 30 year sustainability mentality. But that's all I really have for you. What's the best place, Josh, for people to find you?
Our main website, freelandventures.com, freelandventures.com/passive. There we have everything from some trading videos, but our portfolio, learning more about investing, our different team, everybody on our team with our bios, everything's there at freelandventures.com.
Are you actively raising money for syndications? Just curious.
Not right now. I don't have anything in my pipeline that we're raising for. We're always in acquisition mode. Like I said, last week, we just had 3 deals that we DQ'd at the last minute that we didn't buy. Otherwise, I'd be having a totally different conversation today. I'd be raising money. But, we'll have deals that will come. We've got several offers out on deals right now. I've got a piece of land I'm going to develop next year in 2023. Cool. But nothing right now that I need money for now.
Awesome. Well, appreciate you having on the show. This was great. A lot of great advice from you. But everyone, thank you so much for joining. If you guys have already not, please like and review our Apple podcast. It really helps this business grow and spread our mission to much more people. Other than that, thanks for joining, and we'll see you guys next episode.